Hey, good afternoon, everyone. This is Cliff Morgan with an Nest Egg Builder. We are very excited to have here today with us Larissa Greene from Advanta IRA. Larissa has been with Advanta IRA for nearly 12 years and is currently the Director of Education. Today, she's going to be talking to us about the benefits of investing from a self-directed qualified fund such as traditional IRA, Roth, health savings account, and solo 401k. And there might be a couple of extra things she's going to throw in there too. There have been some changes since December of 2022 with the Secure Act 2.0, and that will be touched on as well. And with that, Larissa, I would love for you to take the floor.
Okay, great. Thank you so much, Cliff, for inviting me to speak today. I'm really excited to be here. I did put together a presentation for you guys, and I let Cliff know that I will share the PDF of the slides with him so he can share them with you. So if you guys wanted to go back and review that information, you certainly could. As Cliff mentioned, I'm with Advanta IRA. We handle self-directed retirement accounts, and I'll talk about what that is in just a moment. I have been lecturing and teaching and sponsoring events all around the private investment sector for a lot of years now, and I really enjoy what I do. And some of the greatest things about working with self-directed retirement accounts is I learn so much. So I learn about different investment strategies people are working on and asset classes that IRAs can hold. And talking with investors in the community, like-minded individuals, has been a real treat for me over the last nearly 12 years. So I hate to say 12 years because that makes me feel old, but here we are 12 years later. I work for Advanta, and Advanta is a great company, and we've been doing this business for 20 years. So in the 20 years that Advanta has been in existence, we now have $2 billion in assets under management, and we only hold private investments, but we don't sell anything at all. So we're in a unique situation to help people do record keeping for investments in retirement accounts, but we don't sell anything. And the awesome thing about that is that gives everybody the opportunity to choose their own investments. And so when you're looking at an investment and say, I wonder if this will work in a self-directed account, we can help you answer those questions, and we're here to help you with those things, and also do record keeping for your private investments. Just really quickly, something Advanta does not do, we do not give private investment or tax advice. Our role truly is to just help you with the record keeping. If you have certain questions that you're wondering, I don't know if Advanta can answer this or not, feel free to ask me. I'll let you know if that's a CPA question or if it's something I can help you with. A lot of times we are talking about things like annual contributions and Roth conversions, which I'll touch on, and some taxable events in an IRA account. And sometimes we can give you the rules or the gist of that information, but ultimately you may have to take that information back to your CPA to find out more about how it will affect you personally, because a lot of that stuff is going to be based on your personal income and how you file your taxes. So what is a self-directed retirement account? I get this question all the time. People will say, I really just don't understand it because my brokerage firm has a self-directed IRA. I have a self-directed retirement account with them. And so I don't understand what a self-directed IRA is outside of what I already have. But I know my brokerage firm isn't going to hold private investments. So honestly, a self-directed IRA, our definition is something very specific. It's different than your brokerage firm's definition, where they're basically selling you from a list of investments and you can choose those investments and allocate how much you want to invest. We don't sell anything at all, as I mentioned, and you choose the investments that you want to choose outside of the market. So we're really not competing with brokerage firms, and typically self-directed IRA custodians aren't competing with brokerage firms because they're willing to hold those investments that are considered private and outside of what a brokerage firm will typically hold. And when we talk about a self-directed retirement account, truly the sky is the limit for investments. There are some rules involved with a self-directed IRA, and I won't go into them today, but just know that when you're making investments, they should be for investment purposes. So if you're investing in real estate, if you're lending money, if you're investing through a syndication or private placement, any of these investments can be done in an IRA, but just making sure that any investments are at arm's length. So meaning that you're not lending to yourself, you're not investing in your son's business, for example. All of these investments should be outside of family members typically. There are a few exceptions, and that they should be investments for investment purposes. when we talk about different asset classes, and I mentioned that I'm kind of learning with you guys all the time because somebody will come to me and say, hey, this is an investment we have, or this is an opportunity we have. Is it something we can do in a self-directed IRA? And the really cool thing is that a lot of times, or most of the time, I should say, they are assets you can hold in a retirement account. So I just gave a very short list of assets here, and you can see real estate in many forms. It could be syndications for commercial real estate. It could be domestic real estate, or even international. We have lots of clients invested internationally. It could be private lending. So whether you're lending to, a specific company or for a specific deal, it really doesn't matter. It's completely up to you if you want to make that investment. You can invest as a limited partner, so where your IRA comes in and gets a limited partnership agreement from a company that you're investing with. And again, international investments, and the list truly does go on and on, but I just wanted to use some examples today that you guys would be definitely familiar with. So again, really the reason most people haven't heard of self-directed retirement accounts, very simply, is that brokerage firms don't offer this option, and there's not a lot of companies out there that are willing to hold private investments. If you're already investing in a private investment through a self-directed retirement account, you know that they are uniquely valued. So they're not, it's not something you can just go and Google how much is the value of this, and it'll pop up with a ticker and you'll be able to find out what it's trading at. That just doesn't happen when you have a private investment. And so there's a lot of firms out there that are unwilling to hold what we would consider a private investment because of things like that. And they're not as liquid, or not all the time. Some investments are as liquid and then some just aren't. And so, what we do is very unique among IRA custodians because we're holding these things that other brokerage firms don't really want to hold. I do always like to give the list of accounts that can be self-directed, because I think sometimes people are very surprised by the accounts that can be self-directed. And for whatever reason, a lot of times people will say to me, well, if I want to make an investment into something that's considered private or outside of the market, it has to be a Roth IRA. And I'm not really sure where that comes from. But the truth is, if it ends in IRA, it can be self-directed. So traditional and Roth IRAs, of course, are going to be the most common investment vehicles we see. And you guys are probably pretty familiar with traditional IRAs, at least, and possibly Roths as well, because if you had an old employer plan, for example, and you moved it to an IRA account, it typically would go into one of these two vehicles. Also, these are probably the most common accounts people just establish to contribute to. So if you were making your 22 contribution up until April, or you're looking to make your 23 contribution, your 2023 contribution, then usually people are doing that with either a traditional IRA or a Roth IRA. And the difference between the two, very simply, a traditional IRA is considered a pre-tax account, and you're typically going to get a deduction for making that contribution. And a Roth IRA is considered an after-tax account where you don't get that deduction, but then your earnings would grow tax-free. I also have up here SEP IRAs and simple IRAs, and these are employer-based plans. And so if you are a self-employed individual, or if you have W-2 income, but you have a side hustle, so you have some self-employment income, you can have these plans as well that will really help you save for retirement. And then, of course, solo 401ks. And these are all three of these are great vehicles, and they're great ways to save if you have self-employment income. I also listed up here former employer plans, and as I mentioned just a moment ago, you can move a former employer plan. They are obligated to let you move it, and you can move it to a traditional or a Roth IRA, but of course it can go to an employer-based plan as well, and then you can self-direct it. So that movement of funds gives you the ability to really take control of that retirement account that typically gets left behind and sometimes forgotten even. So once you've left an old job, you've severed ties with that employer, it's very easily to move into your new job or into your personally owned business and sort of put that to the wayside. And so it's just sitting and it's no longer being contributed to. So it's not really growing in the way that it should or could. And so if you wanted to roll those funds over into a traditional IRA because it's pre-tax, or a Roth IRA because it's after tax, or you want to pay the taxes and have it grow tax-free, you can do that. but you can also look to one of these employer-based plans if you're eligible and really start saving for retirement with the benefit of being both the employee and employer in the plan. I also listed up here health savings accounts and education savings accounts, and the rules for self-directing these two types of accounts are exactly the same. And so a lot of times people are very surprised by the fact that, hey, they have a health savings account, maybe even through their employer, because sometimes employers do give that as an employee benefit, like, hey, our health insurance plan allows contributions to a high deductible healthcare plan, which would also allow you to have an HSA. So we're going to help you with those contributions, but it's also an individual account. So meaning if you have a high deductible healthcare plan and you want to make contributions to an HSA, you just have to make sure your healthcare plan would allow it, and then you could make those contributions, but then also self-direct that plan. So you can find an investment outside of the market and have a self-directed HSA and kind of get those benefits of the returns that you're looking for through a self-directed account. So an HSA is a really cool account. All of these accounts that you see up here, you do have to have earned income to make your contributions. So you have to be paying FICA tax on those earnings in order to make contributions. But the health savings account is the only one that does not require earned income. It will allow you to make contributions based on passive income as well to the health savings account. So it's unique in that. And that account is also considered a triple tax advantage account, meaning you get a deduction for making a contribution. The contribution grows tax deferred while it's in there, and it comes out tax free if it's for qualified medical expenses. So an HSA is a really cool account for that. And there are some benefits if you don't use that money as well. So, if you are eligible or if you're shopping for your healthcare plan at the end of this year, consider a health savings account because it might work for you. The other one that I mentioned is an education savings account, or it's also commonly known as a CISA or a Coverdell account. And this is a plan to make contributions for a minor, typically for saving for college and some other education expenses. So they actually really expanded what you can use those contributions and that account for. And if you have questions on that, let me know. Unfortunately, they haven't changed the contribution limit on that account in a very, very long time, but it can be used alongside your 529 plans, and it can be self-directed. So it's cool in its own way because not only can you self-direct that, and the contribution limit might be low, but when you're making private investments, as you guys know, it sometimes doesn't take a whole lot of capital to get into a private investment. And so you might have a benefit in that education savings account. So I wanted to include the contribution limits up here because I think another question I get a lot about self-directed retirement accounts is, well, this is just an account for a private investment, but it's not a retirement account. It's not really a traditional IRA, or it's not really a Roth IRA, right? And it actually is. We are an administrator, just like your brokerage firm, for retirement accounts, and the rules are going to be the same completely across the board. And so when you have a traditional or a Roth IRA, your contributions are $6,500 for 2023, for example, and you can make those contributions with your self-directed IRA administrator as well. So you can continue to grow your account with your investments, but you can also make your annual contributions as well. And I listed them for all the accounts here. And with 2023, of course, the contribution limits did go up, and they did go up pretty substantially for SEP IRAs, simple IRAs, solo 401ks. And then a really cool thing about the SEP, simple, and solo 401ks is there are some changes that were made that are going to allow you to look more towards tax-free growth in the future. So I'll talk about that in just a moment. But you can see where if you're self-employed, if you have some self-employment income, these plans can really be a big benefit to you. And then you also have the ability to self-direct them, which is really cool, and make those private investments that you see fit. So I know Cliff said that he gets a lot of questions about tax-free growth and how to get money into tax-free vehicles, and specifically about backdoor Roth IRAs. And so I wanted to talk a little bit about that because I'm also going to talk about changes with the Secure Act and how you can get tax-free growth. And some of these strategies are a little more complicated. And so I'm just going to touch on them now. But I did tell Cliff I'm going to share a link with him from a webinar that I actually did today on backdoor Roth IRAs and also mega Roth 401ks because they are great vehicles. The concept of them is a little more advanced, so we could get into a lot of questions and a lot of answers here for these, but I'm just going to touch on it by saying if you make too much money, so if your modified adjusted gross income is too high to put money directly into a Roth IRA, you can still get tax-free growth on your investments through a retirement account. You would simply open a traditional IRA first and then convert it immediately to the Roth. Now, there are going to be some tax implications here, and there are going to be some factors that come into how that money is taxed when the conversion is done. But I'm going to simplify it today just by saying you would receive a 1099 for the Roth conversion at the end of the year for you to pay the taxes. And you can talk with your CPA about how those taxes would be applied to that additional money brought into ordinary income. So just know that there's a 1099 generated, and that 1099 is going to take that money or amount converted and bring it into ordinary income for you in the year that you do it. So it's not a tax burden to the retirement account. It's a tax burden to you personally in the form of ordinary income. But the benefit here, of course, is that you're going to enjoy that tax-free growth on the Roth IRA that you create by doing this conversion. So when you do the conversion, you get that money into the Roth IRA, and only two things have to be true for that money to be tax-free, including any earnings. The account has to be, or excuse me, the money has to age for 5 years. So from the date of that conversion, it's going to start a clock. That's going to start a 5-year aging period on the money converted, and you have to be age 59 and a half. So as long as that money has aged for 5 years and you've reached age 59 and a half, then all of the earnings attributed to that money are going to be considered tax-free at distribution. So it's really cool. And what you should know, though, is that the modified adjusted gross income limits are on a table that's provided by the IRS. So you can go to the irs.gov website and search income limits on Roth IRAs. You're going to get a table there. If you can't find it, let Cliff know, and I can help you guys find that information as well. But that's how you get money into a Roth IRA through what we call a backdoor Roth IRA. And it's just considered a backdoor Roth because although it is allowed, you have to take a few extra steps to get that money into the Roth IRA. And then talking about tax-free growth, because I know a lot of people are definitely kind of honed in on that term, like I want to see tax-free growth. How do I get there? How do I put money into these accounts? Can I put more money into a retirement account than the Roth IRA will allow? And the answer is yes. If you're self-employed, again, that self-employed term comes in, you do have to be self-employed or have some self-employment income. So again, a side hustle of some sort in order to qualify for a SEP or a simple plan or a solo 401k. And all of these plans now with the change with Secure Act 2.0 allow contributions that are considered Roth. So prior to the Secure Act 2.0, only the solo 401k had a Roth component. That's what we call it, a Roth component to the solo 401k. But now all three of these employer-based plans have the ability to allow you to make Roth contributions. I'm not going to go into it too much because we also are still waiting on some clarification from the IRS on how this is going to be done and how the plans will be updated. So although we know we can do it, the plans have to allow it, and we're just waiting on that clarification just as everybody is. And as more information rolls out, we'll be happy to share it with you guys. But ultimately, I think right now we won't see as many Roth contributions to these plans, or at least the SEP and Simple, because the solo 401k has allowed it for quite a while. But as time goes on, we're going to see more and more people taking advantage of making those Roth contributions to the SEP and the Simple. And then the solo 401k, although it has always had a Roth component, the Secure Act did change it where it would allow employer contributions to also be Roth contributions. So that's different than previously, where only employee contributions could be considered Roth. So that's a pretty significant change. And I think as time goes on, we're going to have more information on that, but we're also going to see a lot more people being able to make those contributions that would be considered tax-free for that tax-free growth. So using funds for private investments, this is something we do every day. And so a lot of times when people are new to self-directed IRAs, they're just not sure how this investment process works. And it's actually very easy. And companies raise capital in many formats. So, and Cliff can probably give us some great examples on those different formats. But they can raise capital with private lending, for example. So you can lend money to a company when they're raising capital. You can also subscribed to their limited partnership or LLC. So they have an offer and they say, okay, we're going to make you a limited partner. There's a general partner in here, and your IRA could be a limited partner in this investment. You can also, buy private stock. So if their offering is for private stock, then your IRA would literally be purchasing stock, not necessarily similarly to the way you do it in the stock market, because that stuff is publicly traded, and there's, really a different way that is handled. Where a lot of times with private stock, we'll see there's actually a stock certificate issued for it, or there's an exchange that's included so that we can help you make that purchase of the private stock. So it's a little bit different than you're used to with the brokerage firm, but ultimately the idea is the same. It's still private, it's still stock, it's just private stock. Sometimes companies raise capital with convertible notes. So you lend money to begin with, and as time goes on in that investment, that note might change to shares in the company or some other benefit to you as the investor. So capital raises are done in many different ways. And ultimately, your self-directed IRA can make those investments regardless of the asset class or strategy, basically by making sure that the investment paperwork shows the IRA as the investor instead of you personally. So a lot of times people will send us all of their investment documents, but they'll have their personal name on it. So we help them correct that and say, okay, this looks great, but it's actually your IRA making the investment, not you personally. And if there's any reason for the investor to sign, it's actually your IRA custodian that is the legal signer for your IRA. So for example, if your IRA is going to be a limited partner in this upcoming investment and there is a counter signature needed for the investment, your IRA custodian is actually going to have you sign it, read and approved, and then ultimately Advanta IRA, for example, would sign on behalf of the IRA prior to making that investment. And I have an example here with a client using $100,000 from an old 401k. They set up their self-directed IRA. They reach out to the old 401k to let them know they want to do a rollover to the IRA, and they provide them with the IRA information, and the money gets moved over. Then the client's Advanta IRA account manager will review the investment paperwork, that idea that we're looking to make sure that the IRA is properly titled as the investor. And then we have the client sign everything, and we make the investment on their behalf. And literally on their statement, they're going to see that private investment. So just like when you have investments through a brokerage firm and you can pull up your online portal with them and see all the different stocks, bonds, and mutual funds that you hold with your brokerage firm, your self-directed IRA can do the same. And you'll see that investment as an asset of that account. And your self-directed IRA administrator will continue to receive income. So if there's dividends being paid on that investment, and also do your IRS reporting per IRS rules. And so that is an asset under the retirement umbrella, and it continues to grow tax deferred or tax free, just as you would expect. And here again is just kind of talking about the investment documents. Again, whether it's loan documents, so a note, if it's a subscription agreement, investment document, limited partnership agreement. Again, the IRA is going to be shown as Advanta IRA Services, LLC, FBO, the client's name and account number. As a client, you can also leave your name off of there if you would prefer, and we could just use your account number and you would let us know. And then ultimately, once you give us permission to make that investment, we will make that on your behalf. And again, that very specific titling is going to show the IRA as the investor so that it retains its tax status. So I like to include this slide for people that are not familiar with self-directed IRAs, and I kind of have the frequently asked questions listed here. So are there taxes owed when I move money to a self-directed retirement account? So they get the scary story of taking money out of a retirement account and how that's taxed and penalized. And this is not movement that is going to cause taxes or penalties. It is just moving from like account to like account. So if you have a pre-tax 401k, you're going to go to a pre-tax IRA and there are no taxes or penalties paid, it's going to go IRA to IRA. So if you have an existing traditional IRA, then you would simply open a traditional IRA with your self-directed IRA custodian, and then that money is requested and moved without taxes and penalties. And it's so important to understand that. You don't want to ask them to just cut you a check, because that would be considered a distribution. You want to have your self-directed IRA administrator help you move that money. Even with an old employer plan, they can't actually request it for you, but they're going to provide you with the information the employer plan needs in order to guarantee that it's not a taxable event when you do so. Do taxes apply to the investment earnings? A lot of times people will say, well, this is a tax deferred account, or this is a Roth IRA account. Taxes do not apply, and that is not true in every case. At times, taxes do apply to investments, and this tax is called unrelated business income tax. And it does depend on the structure of the investment. It is rare that it applies, but you should understand and know about it. It will apply if you are a limited partner investing into a partnership where a financing is used to purchase real estate. So that's one. If you're purchasing real estate directly, of course, and using financing, or if you're investing where instead of passive income being returned to the IRA, you're receiving business income. And I don't feel comfortable explaining that to its fullest extent, but just know that typically income on an IRA, like dividends, for example, or interest income, that's typically going to be passive, rental income, things of that nature. But there are times where an IRA makes an investment and does receive business income, and then in that case, this tax would apply. The tax is to the IRA, not the IRA holder. So this would be treated as an expense, essentially, to the IRA, where it pays the tax every year and potentially does get deductions. And this would be the only case where the IRA would get some deductions, because typically it's tax deferred or tax free and it's not paying taxes. The next one here is this a loan from my IRA? And it is not a loan. A lot of times people will say, when I make this investment, how long do I have to pay it back? And you are not borrowing from the IRA. The IRA is literally making the investment. And so that IRA is going to hold that asset for you. And so there is no specified amount of time to get the money back in the IRA, because it's actually holding that asset. It's not something like, hey, I took the money out, now I have to get it back. It is not the same thing as taking money out of your retirement account. It is an asset, just like stocks, bonds, and mutual funds are. And can I have personal income from this investment? And the answer is typically no. There are some scenarios where we see IRAs partner with people's personal assets and funds. That is a very rare occasion, and you should know more about that if you're considering that. But when the IRA makes the investment 100%, then 100% of the investment income is going to go back to the IRA. It's really easy, as I mentioned, to open an account, get started, and move funds, and then we help you make your investment. Remembering again that you want to make sure you have your account set up with your custodian, and then you request the funds either from your old employer plan, or your custodian will help you request funds from an existing IRA. So if it's in an IRA, your custodian is going to help you move those funds. If it's an old employer plan, they're going to provide you information to do so. And then you're ready to start investing. And remember that your IRA has a specific titling. I have that there in the third block there, where that specific titling is demonstrating to the IRS that this is an investment of the retirement account, and that's going to keep it tax deferred or tax free. And that is all I have.
Fantastic. Thank you so much, Larissa. So if anyone has any questions, feel free to raise your hand, and we'll call on you so that you can ask your questions to Larissa. And while everyone is looking for that, Larissa, I wanted to ask you about the SUP. So with that, a couple of questions. So is there any specific type of structure someone needs to have? For example, does it need to be an S Corp or an LLC, or can there be any other exceptions to that? And then I have a follow-up question to that.
Okay. Yes, that's a great question. Actually, no, you can be a sole proprietor if you're doing, business in your own personal name, or even if you're using an LLC as like a pass-through entity. As long as you have self-employment earned income, you can still have a SEP or a simple or a solo 401k. All those plans are, really geared towards people that maybe don't have a formal business entity established. And, certainly if you do, they work for those as well. But definitely, very small business owners, they might be doing business in their personal name, and that's okay. They can still have these plans.
Very nice. So if someone's 1099, so for example, if they're a realtor and they're 1099, but they're doing it their own personal name, they could still actually create a SEP. And then they would have the ability to contribute up to $66,000 per year in that.
Yep, they absolutely could. And remember that the SEP contribution is an employer contribution. So when you're wearing both hats, employee and employer, you can still make other contributions as well. So they can have their SEP at 20 to 25%, not to exceed that 66,000, but then they can also make a traditional or Roth IRA contribution as well. So they're going to get to be able to do both of those.
Nice. Okay. So is there a catch up on that? So if someone hasn't created one before, is there a catch up for the first year?
The SEP IRA unfortunately doesn't allow a catch up, but it does allow contributions up until their tax filing plus extension. So if you extended for 2022, you can still open and fund a SEP for 2022. You still have lots of time if you're doing that. Yep. It's one of the few plans that still allows that. And then the solo 401k does as well. Your simple IRA does allow it, but you can't establish it now. It had to have been established in 2022. But your solo 401k and your SEP IRA, they can both still be established and contributed for the employer portion up until your tax filing plus its extension.
So when might I do a SEP versus a solo 401k?
That's a tough one. They both have their own advantages, and I think depending on how involved people want to be in the retirement plan, one or the other makes more sense. Typically, with the solo 401k, you're going to have more administration, more calculations, more options, but that could also add to the record keeping to it as well. So it's going to be a little more complicated as far as administration of the plan itself goes. And as the trustee, you're going to take on a lot of that. Advanta offers a full service plan where we can help you with that, but you're still doing your calculations and everything through your CPA. And so it might be more than somebody wants to take on. It's not difficult, it's just more involved. And then the SEP IRA, because it's an IRA account, Advanta is handling more of the record keeping pretty typically, where you don't have to go to like an enhanced plan for that in order to get record keeping assistance on the SEP. But it, based on the formula, you may be able to put more into a 401k. So, they both have pros and cons. And so if anybody's interested in learning more about those, they can certainly reach out to me.
Okay. And you mentioned the formula. What formula would we use to determine the max that we could put in each one?
So for the 401k, it's $22,500 as the employee. So the 401k has three types of contribution. It's going to have the employee contribution, which is $22,500, the employer contribution, which is 20 to 25% of your earned income. So that 20 to 25% varies based on how you file and how you have your business set up. So as a sole proprietor, you're going to probably be able to put in 20%. But if you have like an S corp setup, it's probably going to be 25%. But check with your CPA on those. And so let's say you had 100,000 in earnings this year, then you could put in 22,500 as the employee, and then another 20% or 20,000 as the employer. And then it gets a third type of contribution that's called a non-Roth after-tax contribution that could potentially allow you to make up the difference. So you could maybe get your whole 66,000 in if you're under the age of 50. And then for those over the age of 50, you do have a catch-up contribution. So it would be 73,500 is the total. If you're looking at a SEP IRA, it's just the employer contribution. So you're looking at 20 to 25% of your income, not to exceed 66,000. So a same $100,000, you're going to be able to put 20,000 in. I know 66,000 versus 20,000, there's a big difference there. So I guess if you're really looking to maximize your contribution, the solo K might be the way to go. But again, it comes with a little more. There's a little more record keeping, a little more calculating in there. And so it's not for everybody. But ultimately, based on the formula, it would probably allow you to get more in. And then with either of these plans, you can still contribute to your Roth or your traditional IRA.
Very nice. Okay, I don't want to, corner the floor. Anyone have any questions? Feel free to raise your hand. Okay, we have a question that is in chat. How do we contact Larissa for more questions? So you can reach out to us. We're happy to share her information. And then I got another request to ask you about fees. So
Okay.
what type of fees are involved when you're working with these type of accounts?
So the typical fees that a client would experience for a single investment would be a $50 account opening fee. They would have a $95 investment fee. So at the time that they make the investment, it would be $95, and then the annual fee would be $295. That annual fee is per asset, regardless of the value. So if a client invests $50,000 or $1 million, if it's a single asset, it's $295. And then they're probably going to incur wiring fees. So if their transfer comes in on a wire, it's $15 incoming. If it goes out on a wire for the investment, which is very typical, it would be $30 outgoing. So a client making a single investment the first year could expect around $485 in fees. And then each additional year that they hold that investment, it would be $295. But I do have another option based on the total value of the account, where if you're investing a minimal amount, so less than 15,000, it's $200 a year. And if you're investing with multiple asset classes or investments, then you could potentially save on fees as well by going with that value option. So then you're not married to one option or another for the life of the account. So if you're starting out with a single investment this year, and then you're going to go to a few different investments next year, you have the ability to change your fee schedule option.
Okay. Questions? All right, so let me ask this to the audience. So how many of you in the audience today are self-employed or have some type of self-employed income? You know, just show of hands. Okay, so looks like about a third. Okay, and out of the people that are self-employed on the call today or have any side income that they have for self-employment, do you have any method of saving for retirement that is tax-free right now or tax deferred? Okay, so one. Okay, so this is something that really should be appealing for a lot of people in this audience. So, this is where you really want to ask questions, because if you don't have something like this set up, you really should have something like this set up. There's an article that actually came out today saying that of all the baby boomers that are retiring, only half have any type of retirement that is set up right now. It's very alarming. And I'm looking at this audience. I don't see a lot of people here that are really at that point to retire. So there's still time. And, I'm sure some of you might have some questions. Let's ask.
Does she want
All
to
right.
take the screen share off first, so before we talk?
Yeah, if you could, Larissa, thank you so much. Seema, you have a question.
Yeah, I mean, you're talking about the baby boomers, and you and I have talked about this a lot, Cliff. The millennials are even worse. Even fewer millennials are putting anything away for retirement because they're living paycheck to paycheck. So which means that our kids, or for some people, their grandkids, we need to help them get their act together.
So what's a good way to help us do that then?
What is a good way? Well, sorry, are you asking me or are you asking Larissa?
Well, I guess Larissa, if you have some suggestions there.
I do. When you have earned income, you can help your children save for retirement as long as they have earned income. So the IRS is looking for that earned income. And so if, for example, my kids are little, but let's say that my son was working and he had $3,000 of earned income this year. As long as he had it in earned income, I can help him make a contribution to a retirement account. So he can still get that money into a retirement account and start saving for retirement. So, there are definitely ways to do that. If you're looking at, nieces, nephews, grandkids, or children, and you're looking for a way to help them start saving, with tax deferred growth, you could do something like an education savings account where you start saving for their education. And if they don't use it, it is going to have tax implications when it's distributed, but at least it does have tax-free growth. I'm not a CPA, so I can't advise you, but there are definitely vehicles out there where you can assist other people in starting to save for retirement. So that is always something to look toward.
Seema, does that address your question okay?
No, I was talking even about, young people in their 20s and 30s. I'm just making a general statement that these days people are not saving because of cost of living and stuff, and they are living paycheck to paycheck. And I would like to ask, because Larissa is like my third daughter, and soon she may be my only daughter if my girls don't start behaving. It took Larissa, so 2020 is when I discovered Zoom and when I started learning about all this. It took Larissa 1 year to convince me that you could contribute to a Roth even if your income was more than what's allowed, and took her a year to convince me it's not illegal, and what she was telling me was right, was again really legal, because I refused to believe it. For 1 whole year she had to explain it to me, and it meant after at some point in-person meetings during COVID, and then I opened it, or I had my daughters open it. But a lot of people don't know that even if you are making more than whatever the limit is, you can still do a backdoor or an IRA. You can do a Roth or an IRA. I still get confused in all those, but so it's and I was 59 then, so you can imagine it really was hard for me to learn that, and nobody in my family knew, so that was cool. But,
Yeah, and I think she taught you that backdoor Roths are totally legal.
I know it sounds very underhanded, but it is absolutely allowed. I guess it's a loophole that they have decided not to close because it's been in existence for quite a long time, and sometimes people will say, but if you can't contribute to the Roth IRA, why do they let you get it in the Roth IRA anyway? And I don't really have an answer to that question, except for when you do it, you are paying taxable income. So my guess is that if you still make the contribution and you still do the conversion, then you're still paying taxes, which is ultimately what they want in the end anyway, is taxable income. So that might be why, but I really don't know.
And for those people who
That would be my guess.
Yeah, for those people who do those Roths, Cliff and I'm sure others in Nest Egg have a really great way of showing, if you invest in certain things that Nest Egg has, how that money will multiply tax-free over an X number of years. Cliff did it for my daughter, who's still saying, is that really true?
Can't be real. It just can't be real. But I mean, there's tremendous power in actually having that Roth and growing your money, tax-free in that Roth account.
It was a mind-blowing number.
Yeah, I told her though, I said, don't take anything out. Leave it in. Let it do its work.
He's talking about my daughter, who still thinks that I'm a loan shark and doing illegal things. So
Tina had a question in the chat too that is an interesting question.
So she had asked, how does this compare to a life insurance retirement plan? I don't know if you were able to answer that, Larissa.
I'm not really. I've never really dealt in like life insurance and annuities myself before. And what we do is completely different because we don't sell anything. And so, any of those investment opportunities that would be like a product, so to speak, would be best answered by the provider. Now, I will say typically life insurance is not an investment allowed in an IRA, but I know, like, for example, like annuity contracts and things like that are structured in a certain way that they can be in an IRA and may not be necessarily considered life insurance. And then also the reverse of that is true with life insurance, where some life insurance products mimic IRAs, but they are not. But actually, the only two things you can't invest in directly through an IRA are going to be life insurance and collectibles. So, but outside of that, I can't really speak to it.
Okay. Well, life insurance really isn't an investment vehicle, so that totally makes sense. But for retirement, I haven't gotten a lot of exposure for the life insurance retirement plan, but it's my understanding that the amount that goes into the original cost basis is not taxable, but the amount that's earned in dividends, once that's removed, that would be taxable. So it would depend, I would imagine, Larissa, correct me if I'm wrong, if you're going into a traditional IRA, there would be taxes on what would be taken out with your required minimum distributions at a later date. If you have that in a Roth, then there won't be taxes on the growth that you have there. So I would think that because if you have a Roth option, any time in my mind that you have an option where you have no taxes that are going to be paid, I think that there may be a little bit of a better benefit, unless there's an additional reason for having a life insurance retirement plan. That's just my opinion.
And I honestly don't know how you would make those investments, since they can't be directly purchased through the IRA. So I'm just really unfamiliar, kind of out of my element with that, because that's the extent of my knowledge.
And then Ted asked me to ask about Advanta networking.
Oh my God. Thank you, Ted. We have a networking event every other Friday, and everybody is welcome to join, and Cliff can provide you with that information. And it is something that we've been doing since COVID. Of course, a lot of people, I think, have moved to Zoom because of COVID. And I mean, it's been a really cool experience, because I wouldn't know people across the country like I do now if it weren't for that. Actually, I met Peggy in a group in California, and I am located in Florida. So I would not have met Peggy if it wasn't for COVID networking strategies, where we kind of all shifted gears and started looking towards different ways to meet people, and Zoom came about. And so Advanta has kept up their Zoom networking event, and so that is every other Friday.
Okay. If there's no questions, I will ask another question. So if I understand correctly, Larissa, if you're 50 years of age or younger, I believe that the maximum contribution now is at $6,500 per year, $7,500 at 51 and above. Outside of a backdoor Roth, is there any other way to purchase qualified funds more than that? And I guess you gave one example with a solo 401k. That'd be a way where you could actually come in with a much larger amount, $66,000 or $73,500 if you're over 50. Anything else? Any other way?
Yeah, it's tough if you're not self-employed. So I think a lot of times people say, well, I'm not self-employed, I want to do more than my maximum contribution. And unfortunately, when you're an individual, you only qualify for those individual accounts. If you had some way to earn self-employment income, then that would be a way to sort of look towards some of those other retirement accounts that make you eligible. The only other thing that I could think is the two accounts that are individual accounts, and whether or not you can even utilize them or you qualify for them, would be a health savings account. Again, that one is an individual account. If you have a high deductible healthcare plan, and that plan allows contributions to an HSA, so that's the trick there, is your plan has to allow contributions to an HSA, then you could have an HSA or health savings account, and that would allow you to put more money into a tax-deferred vehicle. And the really cool thing about, of course, the HSA, again, is that it's a triple tax-advantaged account. That's what they call it, basically, because you have that ability to put money in tax deferred, have it grow tax deferred, or excuse me, you get a deduction for the contribution, it grows tax deferred, and it comes out tax free as long as it's for qualified medical expenses. So there's the advantage there. And then again, the education savings account. So if you had somebody that you wanted to make those contributions for, that growth is tax deferred and tax free for qualified education expenses. So, and actually a little more on the ESA, or education savings account, it's kind of cool because you can reassign that account continually to somebody who can use it within your family. And so The rules aren't super clear, so I would get advice from your tax professional on this. But let's say I started one for my son. He's the oldest and he didn't use it all when he left college. I could assign it to my middle daughter. And if she didn't use it all, I could assign it to my little one. And if she didn't use it all, I could assign it to my niece, and so on and so forth. And I really can't find anywhere where there's sort of an end to that assignment of that account. So if you're a tax professional and you know of one, let me know. But ultimately talk to your CPA. But that account has that benefit, which is really cool, because if you have 3 kids like I do, you can continually move it for its tax deferred and possibly tax-free use.
Huh.
But if you
Now,
run out
with-
of family members, it might be.
Like when you look it up, the terminology that they use, it leaves a lot of room for questions. And so that's, again, where I would talk to a CPA. But, you know, I used my niece as an example, or my nephew. And so I can assign it to them. And ultimately the depositor can just simply be named. So there's like a lot of room there, but I still would have your tax professional give you guidance.
Now, when you do that, can you only put that into education and that's all?
So you can only use it for qualified educational expenses as they are listed. However, you still get the benefit of the tax deferred investments, and it would be taxable when you distribute it. So if there's no qualified expense to kind of claim that as tax-free, you get the benefit of that qualified tax deferred growth, and then ultimately it will be taxable when it's distributed.
Can any of that be rolled into a Roth if it's not used?
It can't,
No.
unfortunately.
I was going to make a point about the being self-employed, that I just wanted to make a point about the fact that when people are investing in real estate, they can create an LLC for their investment before they invest, so that creates them to be self-employed. I mean, is that like some strategies that people use?
Not that I'm aware of, but I wouldn't be on that end either. That would be something that they set up with their either attorney or CPA, and then ultimately they just come to me ready to make their contribution.
Well, sure, yeah. Well, I just mean that, that people, instead of getting the investment out of your own name, you can create an LLC to make your investment, even if that's through your IRA, because it can be invested in the IRA with an LLC. And then you could become that, then you could get a solo 401k because you have an LLC.
It wouldn't be considered earned income because typically the investments are going to have passive income. So that's one. So unfortunately, it wouldn't qualify there. And then 2, because it's in a retirement account, it's really not considered income to you. So sorry, I didn't understand the first time you said it.
Right.
Now, if you formed an LLC, or you really don't even need to, but if you had some reason that you had earned income, you know, and Ted maybe could give us some examples of, you know, side hustles where you would have some earned income. You would have earned income that would qualify you for a plan like a solo 401k or a SEP IRA.
How much do you have to earn? Like, could you invest in more? Could you create your solo 401k? Put a whole lot of money in it, but you really only earn $20,000 a year or something.
It's based on the earnings. So if you only had 20,000 in self-employment income, then that's how you would base your contribution for the year.
Okay.
But still, 20,000 is 20,000.
Trying to think of like the loopholes.
Yeah. But you could, if you had 20,000 in earned income with a solo 401k, you could potentially contribute a large portion of that.
So, Larissa, if someone wanted to actually utilize a qualified fund or create one with Advanta IRA, who would be the best place to start with? I imagine it doesn't have to be you. So where would they reach out to get started? Would they reach out to us initially?
So I would definitely help them. And so if you had anybody that had questions or anything, you could certainly refer them to me. I would be assisting.
All right. All right, we are coming close to the top of the hour. Are there any final questions? I think, Ted, I saw you briefly raise your hand there.
Larissa, maybe one more. What do you suggest to people about how they control risk in the investments that they make under your custodianship?
So honestly, I typically refer people back to their professional team, because we don't do any due diligence. We don't provide any advice, tax, legal, or investment advice. And so, it would be up to the client to make sure that they're either understanding of their investment or involving their professional team to help them understand the investment that they're making. Even if that's your CPA or your attorney or the provider, to give you some more information so that you can do due diligence, learn about the asset class that you're looking at holding in your IRA account, and go above and beyond to do your own due diligence. And that's very important with any asset class.
Okay, any other questions? All right, Larissa, you want to talk just in brief about the education program you have put together and some of the regular training that you have each week?
Yes, absolutely. Thank you, Cliff. Actually today I did a webinar with extensive information on that backdoor Roth that I just touched on, and also mega Roth 401k contributions. And really, I could go on and on about this topic, and it can seem very complicated, but it's really a process just that has some steps to it. And so I really didn't go too much into it today during this presentation, but I did do a whole webinar on it. So if you guys are looking to learn more about making those contributions to a 401k, where you can really maximize and actually get $66,000, for example, into the 401k, and that could all be tax-free, how that's done, and then more information on that Roth, backdoor Roth IRA and Roth conversions. I did that today. I also am going to do a follow-up webinar on Roth contributions and Roth conversions. So what we talked about today with the backdoor Roth IRA and the 401k, that's a lot of times geared towards self-employed individuals or people with modified adjusted gross income limits that are higher than a certain amount. And so we're going to dial it back a little bit and talk very directly more about a Roth IRA and its benefits, and Roth conversions and their benefits, their pros and cons, so to speak. That will be a more generalized webinar where you don't have to be self-employed to be able to take advantage of that, like you do the mega Roth 401k, for example. So we're going to talk about that in just a couple of weeks. And so we do have educational webinars every week. We usually do 2 a week, and they're on all kinds of topics. We talk about due diligence and different asset classes and how to do due diligence on those asset classes. We talk about structures of investments. We talk we usually have people come on and talk about, market analysis. My partner Alex is very good at that. He'll kind of do a market update for us, where he talks about what he's seeing and what he's seen in the market, in a previous cycle. So there's always good information going on. And if you guys are interested in learning more about that, reach out to Cliff and he can give you our website and my contact information, and I can make sure to get that information over to you.
Well, Larissa, it looks like that the training that you just did on the Roths and the mega Roths and the backdoor just posted about an hour ago. So I just put the link in there for our viewers today. So feel free to check that out. That'll give you some great information, additional information. I'm going to also copy and paste their YouTube channel and put that down into chat as well. That's their YouTube channel right there. So if you want to learn a lot more about different types of investments that are out there, different strategies that you can use, feel free to peruse their YouTube channel. They have a lot of great information out there, and definitely will help you broaden your horizons on investing and utilize qualified funds. And with that, I think we're going to go ahead and close out the show. Larissa, thank you so much for being our special guest today. I really appreciate your valuable insight on this topic.
Yes, absolutely. Thanks for having me, Cliff.